Hello, my name is Fabian Degen. I'm the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like help, click the link in the show description or visit fmdwealth.com to schedule a call with me. We are open for business. So, what is the topic of this week's podcast? The topic is equitable distribution in New York, the 50-50 divorce myth that quietly costs spouses millions. So, let's dive right in. Most people walking into a divorce in New York have heard some version of the same thing. Marital assets are split 50-50. It sounds simple, and it is a rough starting point for most cases. But 50-50 is one of the most misleading shorthands in divorce law. The actual rule in New York is equitable distribution, which is not the same thing as equal distribution. Equitable means fair, considering a long list of factors. In many cases, the result lands close to a 50-50 split. In high net worth cases where the marital assets and the marital estate is varied and the parties' financial situations are anything but symmetric, it often does not. Understanding the difference between equitable and equal is the difference between negotiating a settlement that looks fair on paper and one that is actually fair in your life. The settlement that splits the dollar value of the marital estate down to the middle can still leave one spouse with significant more or less than the other once taxes, liquidity, and growth potential are considered. This podcast is on how the rules actually work and where the real negotiating happens. So let's start with the difference between marital versus separate property. Before anything gets divided, the first job is to decide what is on the table. New York law draws a sharp line between marital and separate property under domestic relation law 236. Separate property generally includes assets owned before the marriage, anything received by gift or inheritance during the marriage, personal injury compensation, and any other property the parties have agreed in writing should remain separate. Marital property, on the other hand, is everything else acquired during the marriage, regardless of whose name is on the title, plus the appreciation in separate property that is related to the efforts of either spouse during the marriage. The last piece is where things get complicated. A premarital investment account that grew passively is generally still separate. But if either spouse actively manages it, the active appreciation portion may be marital. A premarital business that grew through one spouse's labor during the marriage almost certainly has a marital component to it. So these boundaries cases are where forensic accountants earn their fees. So let's talk about the statutory factors that drive outcomes. Once the marital estate is identified, the court or the negotiating parties looks at the list of statutory factors to decide what an equitable division actually looks like. So factors include, for example, the length of the marriage, the age and health of each spouse, the income and property of each spouse at the time of the marriage and at the time of divorce, the loss of inheritance and pension rights, the tax consequences to each party, the future financial circumstances of each party, the difficulty of valuing certain assets like a closely held business, for example, the wasteful dissipation of marital property, and any award of maintenance. So in a long marriage with relatively similar earnings capacity and straightforward assets, these factors usually produce something close to a 50-50 split. In cases with significant differences, illiquid assets or complex compensation, the factors can push the result meaningfully in one direction or the other. And the further apart the parties are, the more room there is in the statute for a court or a settlement to land somewhere other than exactly down the middle. So let's talk why equal dollar value is rarely equal real value. Here's where the financial planning lens matters most. A settlement that splits the dollar value of the marital estate exactly in half can still leave one spouse with a significantly better deal. So why is that? For example, $1 in a Roth IRA, $1 in a traditional 401k, $1 in a taxable brokerage account, and $1 of home equity are not the same dollar. They have different tax exposures, different liquidity profiles, different growth assumptions, and different cost bases. Trading the family home for an equivalent dollar value of a 401k sounds equal, but it's not. The home is illiquid, comes with ongoing carrying cost, and will trigger capital gain exposure on sale beyond the homeowner's exclusion. The 401k carries deferred taxes, but can be drawn on flexibly in retirement and continues to compound. This is the calculation an attorney is not trained to do. A financial advisor or certified divorce financial analyst can model out the after-tax, after-cost present value of different settlement structures, and that modeling is often the difference between a fair-looking agreement and a fair one. So let's talk about liquidity, which is the quiet driver of settlement quality. So why is that? So one factor that gets dramatically underweighted in most settlements is liquidity. A marital estate that is balanced on paper can still leave one spouse quite cash poor. Consider a settlement where one spouse takes the marital home and the other takes an equivalent value in retirement accounts. Both sides walk away with the same number on paper, right? But the home-keeping spouse still has to pay the mortgage, taxes, insurance, and maintenance out of current income, while the retirement-keeping spouse, or consider a settlement where one spouse takes the business interest and the other takes liquid investments. The business owner now has a concentrated, illiquid position that cannot be easily diversified, while the other spouse has a portfolio that can be reshaped into anything. Settlement should be built with at least as much attention to liquidity as to the dollar value. So let's talk about marital waste and pre-filing transfers. So the statute also lets the court consider the wasteful dissipation of property. In practice, this means a spouse who quietly moves money out of a marital account, gives gifts to family members, takes on speculative debt, or otherwise reduces the marital estate in the lead-up to filing can be treated as if those funds still existed. The court can add back the dissipated value when calculating each spouse's share. The disclosure window typically reaches back several years, so pre-filing transactions are not hidden by time alone. If you're concerned that your spouse may already be dissipating assets, the time to raise that concern is now with your attorney and a forensic accountant. Patterns that look unexplained at first glance often turn out to be traceable. So let's talk about trading across asset categories. That is where the negotiation actually is living. So the most consequential negotiations in a high net worth divorce usually happen across asset categories rather than within them. So the interesting trades are not 50-50 splits of the brokerage account. They are exchanges between maintenance, asset divisions, and specific asset choices. A common example, the moneyed spouse offers a large share of liquid assets in exchange for a lower maintenance figure or a shorter duration. Both sides can win because the recipient gets certainty and liquidity while the payer reduces long-term obligations. Another example, one spouse takes the house and the other takes the equivalent value in retirement assets plus an offsetting amount of cash. The cash exists to bridge the liquid gap created by the house being illiquid. These trades require modeling, not just negotiation. The structure that looks good in one spouse's column may look very different in the other ones. This is why the most productive divorce settlements come out of a careful financial work, not just careful legal work. So let's talk about what equitable distribution means. Equitable distribution is one of the most consequential phrases in New York family law and one of the most misunderstood. It does not mean equal. It means fair under the circumstances. What that looks like for you depends on the specific of your marriage, your finances, and the life you want after divorce. So the most important thing you can do is resist the urge to anchor the entire negotiation on whether each line item is split down the middle. Instead, focus on whether the overall settlement after tax, after liquidity consideration, and projected forward across the rest of your life leaves you in a position you can sustain. That is what equitable distribution is meant to deliver. With the right team, that is what it can actually deliver. So now, let's focus on some frequently asked questions that my clients are asking us. So the first one, is everything I own before the marriage automatically protected? Generally, yes. But the protection depends on documentation. Premarital assets that have been kept clearly separate in your sole name, not commingled with marital funds, not contributed during the marriage by either spouse, typically retain separate property status. Premarital assets that have been mixed on the other side with marital funds retitled jointly or actively managed during the marriage may have lost some or all of their separate character. Tracing the marital portion often requires statements going back to the date of the marriage. Next question. What if my spouse hid assets during the marriage? Well, hidden assets are one of the most actively investigated issues in high net worth divorces. Forensic accountants are skilled at tracing transfers between accounts, identifying unexplained withdrawals, and reconstructing income from business records. If you believe assets have been hidden, raise the concern with your attorney immediately. New York courts have a wide range of remedies for hidden assets, including awarding a greater share of the disclosed estate to the non-offending spouse. So, next question. Do I have to give up my inheritance in the divorce? Inheritance in general is treated as separate property under New York law, even if received during the marriage. However, if you deposited the inheritance into a joint account, used it to buy jointly titled property, or otherwise commingled it with marital assets, it may have lost some or all of its separate character. The treatment of inheritance is a common pressure point in negotiation, so make sure that you have proper documentation in place to support your case. So, this was my podcast, Don't Screw Up Divorce. My name is Fabian Degen. I'm the owner of FMD Wealth Advisors. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like my help, click the link in the show description or visit fmdwealth.com to schedule a call with me. We are open for business.